And we're back with episode 2 of the Profitability Podcast. Today, I'll be hanging out with longtime friend and our founding father, Ilir Ameti, the original Profitability Partner. And I go back like 15 years, so it's going to be weird to try and pretend like this is like a normal interview. We've known each other for about half of our lives almost. I think I first met you back when you were in college. You were my downstairs neighbor. And most of the time, we would wind up hanging out at social events in a corner somewhere talking about derivatives because that's what you wanted to do at the time.
Yep, I was that guy.
Yep. And to be fair, honestly, it's like high point of most of my social life there. I still wander around parties looking for people that would like to talk about tax law, and it hasn't gone well recently. But yeah, so everything like we hung out back a decade and a half ago fairly extensively and good friends. And then since then, we kind of went our own separate direction. I went off and started a bunch of things. As far as I understand, you went off and bought a bunch of things. Never any of my things, but still. But yeah, I guess let's
You know you
start
were
off and
selling
chat.
things.
That's fair. Yeah, honestly, and they think they were too small for you, anyways. Let's start off our little chat today. Just tell me about like the gap between. So like from the time that you and I knew each other until like we've reconnected again, like what have you been up to? Talk me through the adventure.
Yeah. So after, let's see, we got to go way back.
Yeah.
Between when we met and when I graduated college, I was trying to break into finance, hence why, I was trying to pick your brain so much, even at social events. And eventually I was able to get an internship for an investment bank. And then after that internship, I got a full-time corporate finance offer over at Amazon. So I did that for a very brief stint. Mainly because I wanted to get back into financial services and be a little bit more industry agnostic. The work I was doing at Amazon was great. It was just very niche. And it was so niche in the sense that it only applied to, let's say, one division of the business. I was in the Amazon, like Alexa business or Kindle business, I think it was called. So think Kindles, Echoes, accessories, Alexas when they first came out. So I mean, it was a great experience. Again, I was leveraging my finance background and I was doing finance, so to speak, but it was for products. It wasn't for business. Um, does that make
So like they're
sense?
like I yeah, it's like their IoT and hardware division of things.
Yeah, pretty much. And like all of the
Yeah.
financial analysis I learned, I would do it for like selling products, like to maximize revenue. Wasn't doing it for like selling businesses to like
Right.
maximize the
Okay.
sale.
And it's still like it's functionally the same modeling process. You just have fewer moving pieces. Like it is, I need this one thing versus I have to tie in 15 things.
Correct. And
Yeah. Although to
so
be fair, at Amazon, it's probably still 15.
yeah, yeah. It's funny because at the time, I think this was back in 2016, Amazon was considered like big tech. And you would think like big tech would
Still is.
have all their like infrastructure built out. But when I got there, it was the equivalent of what was the saying there? It was the equivalent of Amazon being built on a bunch of popsicle sticks and scotch tape.
Oh yeah.
Like, everything was very manual.
I feel like you see that pretty much anytime something grows too fast. Like, I mean, because we get this a lot with our clients. Like, anytime anybody just grows too fast, it's like, all right, you've just got tiny little stilts that are propping up what is a gigantic pile now. We should fix all of that before anyone else sees it.
Right. Get the scaffolding it before, yeah, the
Yeah.
visitors come.
Yeah. Exactly that.
So
So
yeah,
does that explain why we have so many ecom customers now? Like, was that the basis for our ecom division or?
I think that was just happenstance.
Okay. Fair enough. Completely unrelated.
Yeah. So learned a lot there. Really enjoyed the experience, but again, really wanted to get back into financial services where I would be working more on the transaction of businesses rather than like individual products to make up the revenue of a business. So I was fortunate and able to secure an analyst position for a family office in Tampa, Florida, where I basically worked on a wide array of asset classes. It wasn't just buying and selling businesses, it was also real estate. It was investing in funds. We also invested in some esoteric assets. Like the one that I love talking about the most was this operation that capitalized on squatter laws in Barcelona.
Yeah. Let's dig into that for a minute. They did what?
Yeah, so we didn't do anything, but we found a fund or like an operation that basically looked to capitalize on squatter laws in Barcelona. So this is what they did. So at the time, I don't know what the regulatory environment is today, but at the time, the law was such that if, let's say you, George, own a condo and
Okay.
you get to go on vacation with your significant other, And let's say I'm homeless for whatever reason. I'm needy and I need shelter,
This
right?
honestly feels backwards, but go on.
So let's say out of need, break into your vacant condominium and
You'd be very
subsequently
disappointed. There's no furniture in this condo. Even in my hypothetical condo, there's still no furniture.
minimalism to the T, right?
Every place I've ever owned, there's like a bed, a bidet, and a projector. Then there's like an office space. That's
And the
my. I've
love
never
seat.
had a couch. That
I thought
yeah,
you had the
that
love
had the love sack. I had the
seat.
love sack. I did not move that thing because that is just there is nothing on God's green earth worse to move than a love sack. It's
Okay.
just like trying to move a morbidly obese dead person. It's unreasonable.
So
Okay,
yes,
so yeah, you're in my condo. Sorry,
I'm
go
in your
ahead.
condo. No, no, it's okay. And then I decide to order, let's say I somehow have the means to order pizza, like by way of delivery. So the pizza gets there. I now have a receipt, which is considered like a bill of lading, I think it was called. I can't remember the exact particular. But because of that document, I am now the legal occupant of your condominium, whether you like it or not. So, and that,
That's it. There's no like period of time requirement.
nope,
That seems like a fairly significant oversight. Way to go, Barcelona. Jesus. All
them's
right,
the
carry
laws
on.
in Barcelona.
So this is like a pirate fund. Like this is like straight up pirates. You worked for pirates. This is awesome.
Well, let's take a step back just to make it more apples to apples to what we were seeing there. So let's say you're the
Okay,
owner, but you weren't actually the tenant. You rented it out. It was, let's say,
sure.
a
Okay,
real estate investment property for you. And let's say the tenant was the one that was on vacation, and now they're no longer the tenant because I, the homeless person, am. So what would happen then is the tenant would move out, obviously, and you would have no recourse as the property owner. Presumably you'd also have like a note on the condominium, a mortgage of sorts, and you were banking on the tenant paying the rent to service your mortgage.
feels
Well,
like a safe bet.
now that you don't have that tenant paying you rent, you can no longer service your mortgage. From the bank's perspective, depending on whether they were the ones who underwrote it or bought the note in the open market, whoever holds the note now has a non-performing loan on their balance sheet because no one's paying the mortgage because no one's paying the rent. So the bank eventually just writes it off completely down to like cents on the dollar. So this is what this operation did. They would go to all of the banks in a very heist-like fashion, pun intended. And then they would ask them, how many of loans do they have on their books? What do they mark them down for? Like, what's the situation, right? And then they would make an offer to these banks to buy these loans for like 30 cents on the dollar.
Okay,
So bank's perspective, if they wrote a note down to like 5 cents on the dollar,
right.
they're making 6x return relative to like where they last marked the market value of that note. So the bank's happy. They're like, yeah, I probably wasn't even going to get the 5 cents in the first place. Here, take it for 30 cents. Then what this operation did was they paid or subcontracted the next phase out to this organization that would go in, knock on the door, get to meet and know the needy person, and then either bribe them to move out or through physical intimidation, get them to move out of the condominium.
So the back just doing the numbers like, well, we're gonna have a bribe fee and the quantity here. And we've got the like, I don't know what that's the proper term
Wasn't
for
even
like,
pitch deck. At a football
yeah,
field, it was like 30 cents on the dollar for the note, a little bribe fee, like all added
yeah.
up to the return.
And then like the enforcement fees, doing the full economics of like, this is totally legal at the time, I guess. I don't know.
Yeah. Yeah.
Okay,
I mean,
yeah.
there were,
I mean, like again, yeah. If you get the whole loan off that, and then you can get it back to being a producing asset. Great. You just got a 70 cents increase on each of those.
pretty
Well,
much. And then there
seven
was
over
also
three. Yeah.
there was some money on, or there was some money spent on cleaning up the place too, because
Sure.
unfortunately, these
Right.
people had, psychological disorders. They weren't keeping the place well. A lot of narcotics were involved. So they have to clean it up. And then they would also invest in security. So once they'd have it like industrially clean, they would invest in like, high tech locks, cameras, such that they could then go out and find a new tenant to rent the condominium. So then they would find a new tenant to rent the condominium, let that tenant pay them for about like 6 months. And now they have a performing loan. So
Right.
then they can turn around and go to another bank.
Package it and ship.
Yeah. And then so 70 cents would have been if they got like the full price, but they would like sell for even like 80 or 90 cents on the dollar just to make it that much more enticing for the bank. Cause the bank's like, oh, I'll make interest plus, the 10 or 20%. And yeah, that was the
Yeah.
shit they
That's. I
built.
mean, honestly, actually sounds like a great business.
That was great. I was a
And
huge
then
fan.
Oh, hang on just a second. I gotta plug this thing in. Ah,
Sure.
totally forgot. I gotta unplug it to get out and then plug it back in just because the way the cord's set up.
No
Uh,
worries.
yeah. Okay, so hang on a minute then. Just did they also? There's I don't know if you can use this. Like it seems like you can completely vertically integrate this industry if you have, say, your own hobos as well. Like if you just send the hobos out.
Well, funny you should say that
I was
because
gonna
we
say, I mean,
joked
just
about
just
that.
building the supply chain here.
Right, right. Let's make it turnkey, total like
Hmm.
integration. So anyways, that was the minority of deals that we've worked on. Obviously, we primarily focused on real estate and corporate buyouts. So like, traditional private equity buying businesses, but we did work on, some of those, um, you know, I don't know how I would describe it, but like esoteric assets, just like one off.
Esoteric assets is a great term.
Yeah, yeah.
This also explains why you have all of our weirdest clients, like all of the like most outlandish and like complicated scenarios. I now get exactly why. Yep, you're the guy for that.
Yep, for
Okay,
better or for worse.
so you were a pirate for a little while,
I
fun
was.
little career path there, and then how long did that like? Was it straight from that into profitability then, or
No, so while I was at the family office, I distinctly remember working on a deal where we were selling an existing company of ours, one that we had previously acquired. And my desk mate, who is now a partner of mine at Profitability Partners, was working on that deal. And I remember the VP very vividly coming downstairs like once every few days and asking my partner, Matthew, whether or not he had found $5 million of EBITDA. Now, when I say found, I don't mean like conjure up or cooking the books.
right?
I mean in the context of looking at one-time expenses over the last 12 months that wouldn't convey to the buyer, that you could like make the logical argument to the buyer that they wouldn't incur that expense going forward. Therefore, when they own the business, their profit is actually going to be that much higher. And therefore, the purchase price should reflect that increase in profitability. So, but notwithstanding that, I remember the VP coming down every few days asking about this $5 million number. It was very magical. So that got me scratching my head. And I was fairly young at the time. So I, A, didn't know what it meant, and B, went to the most like rudimentary sources to find out why that $5 million threshold was so significant.
Yeah, this was before Chat GPT, so your sources are actually involve research.
Research like wiki, go to
Yeah,
the source, read a book
yep.
or two. And so
Maybe
what I
even talk
found
to a
out,
human being. I don't know.
yeah, that too.
Wild.
And so what I found was that businesses that do less than approximately, it's obviously, a ballpark, but approximately $5 million a year in profit, in also known as operating income, those businesses are not as attractive as their counterparts that are doing more than $5 million a year, more than 5 million a year in operating income.
And
For
this is like a
several reasons.
weird heuristic. Like it's a somewhat arbitrary number, but there is some reasoning behind this. Like the difference between less than and more than 5 million is what from a perspective of a buyer at that point. Like why is it as important as it is?
Well, so that got me digging, right? I started asking those
Okay.
questions. At the time, I learned that valuations for businesses drop significantly because A, when you're looking at the mergers and acquisitions industry, there are two sides to the market. There's the buy side and the sell side. And each
I'm with you so far.
intermediary essentially facilitates transactions in the market, right? And so the sellers, those who sell businesses on the sell side, are incentivized based on their compensation structure, which is usually a percentage of the sale price. And believe it or not, it takes probably the same amount of work to sell a $5 million business as it does to sell a $30 million business.
Yeah. Feels about right. Like honestly, like at a certain point in time, it's actually probably even easier because things are documented more consistently at a certain scale,
Yeah, for sure. Once you
right?
get to a
Like
certain
that's
level,
all of our littler clients that want to move is just like, I can get this to happen for you, but I need to write down everything that you haven't been writing down for 6 months just to prove that you exist, basically. Whereas like
right?
at a $30 million business, like most of the basics are already recorded and tracked because you couldn't have gotten that big otherwise. So like I can at least say, all right, here are the gaps and they are manageable. And also the historical data probably exists. I just need to get it organized for you. Yeah.
Right, right. Yeah, I would say definitely more orderly the bigger you get, but from just a sheer manpower perspective, it's still about the same amount of time, right? There's more data, it's organized, but you still got to kind of comb through it. And then on the smaller side, less data, but it's super fragmented, as you've seen,
Okay.
as you
Yeah.
know.
Yep. To be fair, like yeah, that's all of my businesses. That they're always very, very fragmented up until about 2 million. Into which one is like, cool. I now have enough margin to get somebody to make this clean for me.
Absolutely, absolutely. So for that reason, the sell side players in the M&A market aren't really like incentivized to sell the smaller deals if they're going to make way more money selling bigger deals, all else equal. And then on the buy side, it gets a little bit more mathematical. I'll just try to like be as efficient as possible. So financial sponsors or professional investors in the mergers and acquisitions market typically raise a fund from high net worth individuals or institutions to then afford the ability to go buy these businesses, right? When they raise this fund, they then have to go and buy X number of businesses to deploy the money they just raised. The way they get paid usually is through the 2 and 20 fee structure, which is commonplace in the financial services industry.
Yeah, that's
2
been
and 20.
stable for a long time.
Yep. Yep. And, some people will like play with that number and they have their justifications. But yeah, that's the norm.
Yeah, I've had a few for like I've got a friend raising a fund right now, and she was asking about like what she could get with her fee structure because she wanted to put part of it towards a nonprofit. Like, can I raise it above two? And it's like, can you persuade rich people that you are more valuable than everyone else in the industry? Because otherwise, 2 and 20 is your best anchor. Yeah,
And there comes the justification.
right.
So
Carry
people will
on.
try to justify it. They'll try to justify either
Yeah,
higher or lower fees for whatever reason. But 2% is usually the asset management fee that these fund managers charge to their investors. So if the fund raises, let's say $100 million from their investors and they charge 2% a year, their investors have to pay them in total $2 million a year just to keep the lights on, right? To pay their payroll, to pay for their office, to give them the resources they need to go and source these opportunities for the investors, because that's why the investors are hiring them. They don't have the time to go do it themselves. And then the sort of ticket to the promised land is the 20 in the 2 and 20 fee structure, which means of all the profits that the fund generates for their investors, they get 20% of it. So if we were to take like the golden standard in private equity and say that, a fund that raised $100 million doubles the value of their fund over 5 years, there's a lot more minutia to that, how that works out. But just for
right.
simplicity's sake,
At a podcast level.
at a podcast level, right? Uh, that would imply that they generated $100 million of value of profit for their investors, right? Going from 100 to 200, which then means they're entitled to 20% of that, or $20 million over the period of 5 years. So very lucrative business model. However, this is where it gets tricky from a size perspective. So if I raise $100 million and I've got like a small team, usually with $100 million, if you're charging 2% a year, $2 million, you probably don't have a team bigger than 10 people. You can only buy so many businesses and manage them and report them because you're constrained by the size of the fund and the size of your team. So the question then becomes, would that private equity firm, that investment firm, generate more profit for their investors if they bought 100 $1 million businesses or 10 $10 million businesses? Chances are with 10 people, you're going to
Yeah.
probably drive more value. You're going to be able to give more resources and attention to 10 companies versus 100 companies. Oh, go ahead.
Well, I'd say that I follow. It's the 10 people that are killing you there, because like I imagine it'd be much faster and easier for me to grow a $1 million company into a $3 million company than it is for me to convert a 10 into a 30. Then yeah, that's just
Mhm.
my particular skill set. Like I mentioned, it's possible that like if you have the playbook and can throw the funds at it, you can get 10 to 30 just as quickly. It's just gonna be slightly more expensive in terms of overhead.
Right, right.
Yeah.
Well, for that reason, the buy side demands smaller businesses less so than bigger businesses, and the sell side supplies smaller businesses less so than bigger businesses.
So
So
everyone's being pushed up.
everyone's being pushed out, supply and demand.
Yeah. Yeah. Okay.
But for that reason, smaller businesses sell for a lower valuation, which makes it attractive for smaller buyers who are willing to get like involved operationally to really try to
Yep.
magnify their returns.
So they're operating in like the long tail end of things.
Correct.
Yeah.
Now, here's what I didn't know at the time working in the ivory tower of finance. I was like, oh, this makes sense. Supply and demand. Okay, sellers want to sell less of this product because it's not making them as much money. Buyer want to buy less of this product because they can't make as much money. That's probably the only reason, right? Why these smaller businesses sell at much lower valuation multiples. Well, then I decided to spin off and start my own investment practice and buy a couple of these smaller businesses that these institutions didn't want to touch.
Yep.
And I learned a lot more. I learned basically everything you alluded to
Yeah. So
earlier.
now you're in my world. It's all chaos.
It's chaos, no standard operating procedures, no definition or even ability to verify profitability, a lot more riskier bets. You're really flying in the dark, less systemization. And those things are valuable to the bigger buyers and sellers of businesses because they love clarity. They love transparency. Like that is almost valuable to them as the business's profitability itself, because they want to be able to go to sleep at night knowing, all right, there's a high degree of probability that this is true, that this is going to succeed, and I'm going to get my money back plus some.
Right. I mean, it's again, like you don't want to be buying magic beans. The magic beans might work and they very well might not work. And at that scale, if the magic beans don't work the way that you're hoping for them to work, the whole business can go away with one big mistake. Like that's one of
Yes.
the bigger differences between like a 10 million and a 2 million. It's just like you can kill a $2 million business in under 6 months. You could kill a $10 million business like that, but like you'd have to be working for it. Like you'd have to try.
Kind of what I always used to say about my classmates who get like D's or F's. I'm like, there's a curve. If you're getting a D or F, you're like actively trying to kill
Right.
your
Like, yeah,
like purposes
you could
of
drop
not
from a
studying.
right, like you could drop from a B to a C just by like slacking off for a bit. You could drop, but to drop from a C to a D, you got to actually be literally trying to kill brain cells.
Why? And if you're in an F,
Yeah,
you're literally like one of 2 or 3 students out of a lecture hall of 500, like at the bottom of the barrel. Like, what did you do to get there?
right. Like this is the competition was not entirely all that high. There were other people out there also killing brain cells. You managed to kill brain cells better than they did. Like that was actually that's its own separate skill set now.
Right. You did good at
Unfortunately, not
school,
rewarded.
just not at the part you get graded on.
Yeah, yeah. You did great at that other part they advertised in the movies. Not a lot
Right.
of career paths from that one. Try marketing.
Yeah.
All right. So we've now gotten the foray from we've now gotten like the whole career, the trajectory, and the adventure goes from the big businesses learning all the math to do things down to the small businesses and understanding that the math is about 40% of it, maybe half, and then the rest of it's actually just keeping people organized and like implementing this process in the first place. Which to be fair, like I actually learned a lot about this from working with you guys, and this has been fun for me because I'm like now that I'm working with you guys, I'm looking back at all of my past companies and being like, wow, yeah, I made the same mistake 4 times in a row, didn't I? How about that? And it is true. Like I've got the two that I'm still actively maintaining right now, the vet clinic and the plumbing company. Both of them are still significantly less organized than a lot of our clients are, and it's mostly just because, like, yeah, it's running off of magical beans. I know how the things work and what needs to happen where and when. And I'm looking at myself thinking, like, yeah, I should really write all this stuff down so I can get somebody else to do it now. If I ever want to sell it, I should probably be doing that several years ahead of time, huh? And
Definitely want to
yeah,
do
well,
some
I've got
lawyers
some projects. Yeah, I've got some projects queued up for the next couple of years for those.
out.
All right. And so that was your first little investment fund. You started off a couple of small businesses, discovered chaos. You need to get like below a certain scale, you need to get your hands dirty. Like you have to get involved in the ops unless somebody else has already graciously done that for you. Shameless plug, Profitability Partners. And then that pivots into Profitability Partners.
Close.
Okay, we
So
got more steps.
yes. So just one more step. I promise it won't be that long, even though this has
No,
been
that's
pretty
fine.
long.
We've got a solid hour. I'm learning things here.
Uh,
This is fun.
cool. So yeah, what you said is correct. I did buy a couple of small businesses. I learned a lot. And what happened was through those learnings, I actually became a lot more selective in my screening process for new companies to buy. So I hadn't totally exhausted the funds that I had raised, which most investment fund, well, actually, it depends. I shouldn't say most. If you've raised a committed fund, you're probably going to try to buy several companies. If you're a fundless sponsor and it's your first time being, doing a deal, you probably just buy one first, get it right, and then, buy another one. I was a little bit more ambitious and a little more naive, admittedly, and I try to, buy more companies. But because of my lessons learned in the first two acquisitions, like I said, became a lot more selective when screening for new opportunities. What that resulted in was me spending a whole bunch of time saying that there's nothing out there good enough for me. I was being like, so selective that I was being honestly delusional. Because like
Okay.
how how
So
how
we
can you find
pendulum from one end to the other end. Like we pendulum from one
yeah,
side of
yeah,
this to the other
exactly.
side.
Right. So like, and then what that resulted in was me just spending a bunch of time looking for an acquisition target that just didn't exist. Like a small company that had all their, ducks in a row, their T's crossed, I's dotted, financials verifiable within a certain, size range because I only raised so much money as a first-time fund manager. Well, I
Yeah, you're gonna take
eventually
a
ran out of
serious.
cash.
Yeah, so you're gonna
What's
take a
up?
serious discount on the EBITDA available at that point. Like if you're paying, 'cause you're
Yeah.
gonna be paying premium multipliers at that point.
Yeah. Yeah. Oh, yeah. I was definitely like businesses that I were buying back then were like, between 1 and 2 times EBITDA. So if I
Okay.
could keep the ship afloat, like I would get like,
Yeah.
50 to 100% return.
I mean, if it doesn't go under, you're already winning.
Right.
Go ahead.
Right.
Yeah.
But then COVID happened right after I bought my first two businesses.
Mm. Ooh.
Yes. And I made an investment in an industry that was super COVID susceptible.
What
So,
were you in?
like you said earlier, like smaller businesses, a lot more volatile. One of the smaller
Hmm.
ones that I bought, which was more of like a subsidiary to the former one that I bought, got totally wiped out because of COVID. The other one fortunately did well enough where after, operating it for 2 years and exiting it, I was able to get pretty close to break even across both companies. There was
Okay.
a slight loss, but considering that, one business got totally wiped and that, the sky was falling for a couple of years, I was pretty proud of my team and what we were
Yeah.
able to do. But again, I wasn't able to find, more businesses to buy. Now, here's where it really got grim for me. Because I was a first-time fund manager, going back to that 2 and 20 we discussed, I wasn't able to convince investors to pay me the 2. They pay me the 20.
Right.
They're like, "Hey, if you make us money, we'll give you a cut, but we're not gonna pay you to go looking for deals because you don't have a track record of being able to find them in the first place."
Yeah.
So,
I mean, to
I
be
got
fair, their reasoning
paid
seems solid.
very solid, and I got paid again when they made money, but also, like, when deals would close. They would give me, like, a small percentage of the transaction value, similar to, like, a brokerage fee, right? So, I was kinda banking on doing more deals to pay my own bills, but eventually, I ran out of savings. So,
Yeah.
admittedly, I was about to give up on entrepreneurship. I still remember to this day, I was in my co-working space, packing up my banker boxes, getting ready to, walk out. And two of my friends who were, in the same co-working space as me saw that I was packing up and asked me, they like intruded in my office and said, "Hey, what you doing?" And I said, "Net entrepreneurship, gonna go find a job." They're like, "But Alir, you know so much finance." And I'm like, doesn't pay the bills, need to go get a job. And they were like, and mind you, they both had businesses of their own. That's how we met, my two friends and I, at the co-working space. They were like, well, we have businesses of our own. Why don't you do finance for us part-time? We'll pay you for that work so that you can cover your bills and that'll afford you more time to go find another acquisition target. And I was like, well, I thought of that opportunity before, but sure, let's hash it out. So we stayed up until like 2 in the morning in one of those co-working conference rooms, just whiteboarding everything out, like what I would do, what they needed help with, what the price would look like, how it would be a win-win for both of us. And so that's kind of how profitability started, very covertly and very colloquially. There was no entity, there was no branding. It was just me trying to make a living and pay the bill so I could go find the next big thing.
I mean, it kind of sounds like it was Profitability Partners was started because you were good enough at what you did that other people wouldn't let you not do it. Like
Yeah, I guess
this
that's
is very much a
the half.
this is how you're supposed to start a business, which is like you identify market demand first before offering a product. In this case, the market demanded that you do this. And you're like, well, all right, I guess
It's a
sure.
very half cup full way of looking at it. And it's so funny that you say that because my equivalent of what you just said is yes, founders, visionaries, they typically see a big problem in the market and they try to come up with a solution to create a whole bunch of value. Then they go and they build it. For me, I just kind of kept doing what I was doing until the opportunity fell in my lap. And then I was like, oh, this is a problem. I'm the solution. Oh, I should do this then. And actually, that's how Profitability Partners formed. So after those two guys and their businesses, they referred me then to their colleagues. I guess I did good enough for them. And those two colleagues then referred me to colleagues of their own and so on and so forth. And by about client number 6 or 7 is when I had this epiphany where I was like, wait a second, I need to step back. Maybe private equity isn't the most attractive opportunity for me right now. Maybe it's this underserved market for small business owners who are looking to either maximize profitability, have their business be able to run on all autopilot, or just simply be able to like sell for the most money possible. And I was like, okay, I'm gonna go do this then. I'm gonna go do those 3 things.
Yeah. I mean, this feels like the exact way to get started as an independent operator, which is like, yep, this is slightly harder and slightly less valuable, but there aren't as many people competing for it. So I can do this, and I can do this at a scale well enough that I can build up the basis and the bankroll so that I can move back into the more competitive sphere and be competitive at that level. In the bigger market, like, yeah, you can, no matter how good you are at this, you still need the capital to be able to play.
Absolutely, absolutely. And at the time, I didn't have capital; I had time. So I'm like, okay, let me go trade my time for capital and then, see what we can build there. So yeah, so from that moment on, I tried courting and recruiting my now two business partners from their private equity or buy side jobs because they kind of understood the opportunity, right? They were also buying businesses on the smaller side, trying to get a good deal or a discount on valuation for the reasons, basically, 4 reasons that I was, helping my clients with. And so they were like, "Oh yeah, I can just do those things with you, help these business owners kind of prepare their business for a sale or optimize them, so to speak, so that when they do go to sell, there isn't this massive wealth transfer from these sophisticated buyers and these small mom and pop business owners. Because that's what usually happens, right? If a big buyer's coming in and they're getting a deal on your business, there's a lot of wealth transfer happening. You're just leaving a lot of money on the table. And unfortunately, those institutions are the ones taking it.
Right. Yeah. The buyers are essentially sucking value out of your time.
Yeah.
Yep. I've had that
And all
happen to
the
me a
time
couple
that
of
you put
times.
in your business, right? Like 40 years. Like imagine you spend 40 years building a business and you only sell it for half of what you could have gotten if only you had taken like the necessary steps preparing for the sale.
Yep. I have this conversation with people a lot, which is like, if you spend 10 years building something up to $3 million in profit margin, 18 months can get you pretty much a 100% increase on that sale price. So it's probably worth sucking it up for the last year and a half to get the other half of your value out of this thing. And again, I've screwed this
Right.
up in most of my businesses, actually. Most of my exits, I have screwed this up. So very, very personally poignant here. Cuts deep. Yeah, no, I'll be passing you a vet clinic and a plumbing company eventually for at least 18 months before I'm ready to get rid of them.
Well, I appreciate it.
I promise you I will appreciate it more. Um, all right, so that brings us up to current state of the fund where or firm where we have the three partners and the current book of clients. And then you guys kind of partition out different industries for the most part. So like trades typically go over to Matthew for very obvious reasons. If you haven't seen episode one, watch episode one. There are not that many people that are more well versed in the industries he works in. Phenomenal guy, very underspoken. And
Uh-huh.
then Raymond tends to take a lot of the agency and ecom business. And then you get all of our interesting clients, basically. Everyone who's doing something weird and fascinating, usually. Like I've got a couple that I'm going to be chatting about with you next week because I have nowhere else. I have no idea where to put them.
Yeah, I'm like a catch-all, I guess you could say.
Yeah. Yeah. I mean, I get why, having now talked to you about this on numerous occasions, combination just like the general enthusiasm for new and interesting puzzles, along with just the depth of knowledge and understanding in the industry. Like, I get why we give you all the hard stuff. By the way, sorry about that. Um, yeah, I guess
It's
like
okay. You just my life
talk me through a
interesting.
couple of interesting puzzles recently. Like talk me through what you've been up to recently. Like what are those couple of the things that you're most proud of that you've done for folks? You can leave names out of it unless you want to plug somebody. If somebody's doing something cool that you feel like plugging, by all means. It'll be seen by maybe 4 people at the moment. This is episode 2, so we don't have much of a following yet.
You feel a lot better talking about or sharing some of the stuff I've been working on. Let me think. So, in the past year, I've held a last mile delivery pharmaceutical business. They're essentially think of like Uber, but for pharmaceutical drugs from like Walgreens or CVS to your home. Um, they had grown from nothing to like let's say three-ish million dollars a year in annual revenue in a matter of 4 or 5 years, which is pretty impressive. They did raise, some venture capital financing to support that growth, but they sort of reached plateau for several reasons. One, when it came to their commercialization efforts, the founder was doing all of the sales. Which is typical, right? If when you're starting from nothing, and you don't have the resources to go hire a sales team. You kind of have to do founder-led sales yourself. But there's only so many sales calls in a day that a founder can take. Secondly, the business sort of stalled financially because they didn't have the right financial resource in place. What I mean by that, excuse me, is that not all financiers are created equal. There are some financiers that are suited for different stages in a business's life cycle. Like for example, we would not be a good fit for a Fortune 500 publicly traded company because there are just so much more that you need to know about with respect to the laws, right? Because you're subject to way more scrutiny as a publicly traded company, disclosure requirements, and usually the financial leadership of one of these Fortune 500 companies is more of like a figurehead. They're usually the ones just kind of like managing, the relationships between stakeholders. They're very big picture, very high level. Whereas, a finance resource for a smaller business has to be able to roll up his sleeves, has to be able to, go like work side by side with the founder in the trenches to really understand what's going on operationally so that whenever the founder wants to make a change to the business, he has his financial partner to tell him, hey, this is what the financial impact is going to be. And I've been referred to as financial samurai at times by more colorful clients. I
You
tried
get some funny ones.
to say financial partner, but they were like, yeah, financial samurai. So, anywho, they didn't have the right financial resource in place. As a result, they had lost trust from their pre-existing investors, most of the shareholders on their cap table. They had lost confidence from their board members, i.e., the lead investors from their previous round. So they're one of their larger shareholders,
That's
right?
kind of a big deal.
Kind of a big deal, especially when you're a startup. Because if you're a startup, you're usually burning money to grow, right? You're spending not only what you generated in revenue and in gross profit, but you're also spending and some to like afford or to hire growing your team, to continue building your product, to continue expanding different markets, right?
Also, if you're raising money and the last guy that gave you money is not happy about the decision, that's kind of a bit of an anchor on that one. It's rough equivalent of like going back into the dating pool and your ex-girlfriend's got a website taken out about you. Like, that's
Yeah, it's like
ignore
getting
that.
docked. Yes.
Yeah. Ignore
Trust me.
that. No, no, it was a different time.
So yeah, if you lose confidence in your or from your sorry, if you lose confidence from your board member and your previously investor, that usually signals a red flag to new investors. Also, your lead investor is supposed to kind of be in your corner. They're supposed to be your cheerleader. They're supposed to be the ones when you run out of cash, they step up and say, "Hey, we'll give you some bridge financing to get you to the next level of growth, to reach the next milestone of revenue." So that you can then attract that next league of investors. That wasn't happening. Company was out of cash. We were literally financing operations with accounts payables, meaning trying to plead with vendors to give us services for free today, but then get paid once we secured financing in the future.
Yeah. So that's the or like synthetic debt, if we will. Like we're inventing, yeah, we're inventing a debt situation.
Yeah. Yes. Yes. So my team stepped in, we cleaned up their financials, we built out, very robust reporting systems that gave both shareholders and the board members very granular insight into the company's KPIs or key performance indicators, which then gave them the confidence to say, "Hey, I actually know what's going on with the business. It's stalling because it needs a sales team. It's not raising capital because the finance resource before wasn't able to facilitate information in a way that would generate additional financing, right?" Once they saw the picture, they stepped in, they provided bridge financing, which then gave us the runway necessary to go attract new investors, which then brought us to where we are today. So I mean the net was, they were stalling on growth because they didn't have enough manpower to take more sales calls, essentially, to go out there and find more customers. And they were incapable of securing financing to support their growth, to fund their burn. So by coming in, cleaning up their financials, building out robust reporting systems around the operations of the business and how it translates to like future financial performance, we were able to reinstill confidence back into our board, our pre-existing shareholders. They then gave us financing needed to extend our runway, which bought us enough time to find a new investor. And now that company is basically turned around completely. I think it was either last month or this month. We should be on track to doing, over $6 million in annual revenue, where we were at like $3 million last year.
Please, nice.
And yeah, the company's going plain. Yeah, yeah. What else have I recently that resulted in a positive outcome? We have another client that's in the college athletic space. So what they are is essentially a marketplace for college athletes, brands, and universities. In 2019, I believe it was, there was a Supreme Court ruling that allowed
Right.
college athletes to start in.
I remember this. Yeah.
Yep. Well, they had a similar story where they were growing, but they stalled, and it was for different reasons than the pharmaceutical last mile delivery company that I just went over with you. Their reason was they hadn't really figured out a scalable product that they could, take to market and really just run with it. They tried the SaaS model, they tried fintech, where they would take like a small cut of like how much college athletes were getting paid for on the platform by brands and universities,
That would have
but
been my
none
first
of it
guess.
really stuck.
Okay. That's unfortunate. Like fintech had
Yeah.
been my first guess in terms of just a good way to monetize things. I had an interesting experience with the fintech companies. Like, wow, you guys make a lot of money, don't you?
Yes. For many industries, it does work, but for this industry, it doesn't. So what we did was we retained a headhunting firm to find us sort of like head of sales or a VP of sales who has sold, college athletes, so to speak, to Fortune 500, actually not even 500, Fortune 5,000 brands. So we procured, a VP of sales who we then incentivize with a compensation plan to effectively leverage his playbook, leverage his experience of having sold a similar service to these same exact companies before, and leverage his relationships within those organizations, whether it be relationships in like the procurement department, the finance department, because selling to big enterprises is a very lengthy process and you kind of have to
Right.
have internal champions to kind of move the chains down the field, if you will. And within a matter of 4 months, the company basically doubled its revenue, its annual revenue, by virtue of selling a pretty big contract to. Big deal there. And again, it wasn't just that; it was the product too. So
Right.
when we were looking at the numbers, we know there was some churn because some of the college athletes weren't, always delivering what they were supposed to deliver, what they promised to deliver.
Can see where that might happen in
We
college.
fortunately, yeah, yep, especially, yep, I'm not going to comment or go down that rabbit hole. But the point is, we looked at, what our technology was doing for our athletes on social media. So the biggest differentiator for my client was or is their technology. It's got a lot of AI in it. I know that's, all the rage nowadays, but what their technology really does is it helps optimize college athletes for specific marketing campaigns for specific brands based on their social media following and their social media presence and their social media content. So
Okay.
because they have all this information, they're actually able to kind of, really bring like cost per impression down
Okay.
significantly
So basically just
for paid
niching
marketing.
marketing down using data. If this makes sense.
Exactly. And so what they found after doing, a bit of like discovery work is that these big brands will pay, I think it's some metric like 20 or 30 cents per thousand impressions. But they're actually able to get their cost per impression down much lower than that
Oh, fantastic.
and basically charge these big brands a midpoint between what market is currently charging and what their cost is. And so it was through this like revamping of their business model of their product that enabled them to sell a massive contract to Toyota. And now they've signed like a contract with two other marketing agencies. One of them is one of the five largest ones in the United States. They've got massive Fortune 500 clients, and they're just waiting to get subbed out some of these marketing campaigns. So, yeah, another project I was super proud of
Yeah.
my team for being able to kind of like move things.
I mean, that one's actually really, really exciting, right? If you can get cost per impression down by a notable margin compared to anybody else, like I know you mentioned like AI is like all the rage. Everyone wants to be saying they're doing something with AI, but there is a good reason for it. Like used correctly, this is an absolutely revolutionary period in human history. Like this is the trick is it's in the pet rock stage right now where everyone wants to say they're using AI because everyone else is using AI. And so like a few people created something cool and then everyone else just slaps googly eyes on it and says, look, I've got a new product. But like, if you do something meaningful with it, like you actually understand the technology is good for, it's incredibly. It is going to be like a bifurcation of business, I think, over the next few years. And so, like, this is yeah, that's actually a really compelling offer. That's pretty exciting.
For sure.
Yeah. And so, what was
I
your
mean,
role
those
with
are
them?
some of the.
Right.
Oh, I was just gonna say, my role with them was a kind of helping them think through how to revamp their business model, how to transform their product really in a way that would enable us scaling at a much higher magnitude. I built out, with them through a workshopping session, a financial model where we projected, what their revenues and gross profits would look like if they were able to achieve certain performance thresholds, not only on the digital marketing side, but in terms of being able to land one of these big contracts. I help them look at like what the all-in costs would be, including this VP of sales and their commission, such that, net net, they're making a lot of money.
I really hope that went in the slide somewhere. Net
I also
net,
help
you will be
them.
making a lot of money.
Yeah.
This is my goal.
Yeah. So it was supporting them in their ideation phase of the new product that they're currently selling, and then also collaborating with them on go-to-market strategies, including, looking for a VP of sales that has the experience, very, very similar or at least tangential experience that could help bring this new product to market in a way that like minimizes risk and maximize reward.
Sounds like a good CFO. All right. So I'm
Uh,
gonna do like a quick hard pivot to like some current events type topics here, just to get an expert opinion on them. So like the first thing that comes to mind that I know a lot of people are searching for right now is what are your thoughts on the upcoming 100% China tariff? Is that gonna actually land? And if it does, what should people be doing about it? And like, what do you think it's gonna look like going forward?
I don't have like a firm position on it. Usually I do when I'm opining on geopolitical matters. But right now I don't have I don't have conviction one way or another. I would say in the past and probably now, you're seeing a lot of companies already proactively getting ahead of it by either moving their operations out of China to like Vietnam or other countries, or just finding other ways to sort of circumvent it. And I would say if you haven't done that already, you're probably behind the eight ball and your competitors are probably going to eat your lunch.
So the general takeaway is that
If I'm
like
just being frank.
the general takeaway from it is you're thinking like if whether it happens or not, you should probably like it's clear that there is risk in just maintaining supply chain through there. It is probably a very good idea to diversify away one way or another because even if this particular tariff structure doesn't land, something's going to. Like things that relationship's just not stable.
I would say, yeah, that's a fair assessment
Okay.
for sure.
Just summarizing. All right. Well, we're probably
Yeah.
coming up on time at this point. I don't know how long people's attention span for these sorts of topics are, but my guess is less than an hour. That or if people have a long car ride, then maybe we can keep going for a while. Anything else that you'd want to chat about for while we're here?
No, it was cool to be able to, talk about Profitability Partners Genesis,
Yeah.
why it came into existence, how it came into existence. And yeah, just looking forward to, producing more content with you and the guys to kind of put ourselves out there and let everyone know like who we are, what we do, how we've helped our clients. And yeah, just continue to get connected with as many people as possible
Yeah, I
and
would
help
love
as
to be
many
able to
people as
turn this
possible.
into like a weekly thing or possibly even like two a week and just do roundtables with the other guys, basically just talk about current events or current things they're working on and get their opinion on things that are happening or coming up, state of the industry for various things. And then potentially like pull in some of our customers too and just chat with them because they're all really interesting and impressive people who have done cool stuff and it'd be kind of cool to get their take on things, pull in some of the broker partners, etc. Basically, I'm going to interview you guys first, just like while I iron out all the kinks. So, like, if my laptop dies, it's not really awkward with a guest. Like, hey, sorry to interrupt your day. I had a battery problem. By the way, Ilir, sorry to interrupt your day. I had a battery problem. But yeah, thanks for taking the time. I know you've got a super busy fulfillment schedule right now. For those of you that aren't super familiar with finance, we're filming this right around the end of a quarter, which means that Ilir is very, very, very popular. So appreciate you giving me the time of day. I will let you get back to your spreadsheets. And again, I'll get set it up for those of you watching, profitabilitypartners.io. If you have a very interesting and complicated company, there's a very good chance you're going to wind up talking to a leader. All right, guys.
Awesome. Well, thanks for having me. Appreciate it. Talk to
Take
you
care,
later.
man.